What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. Title of today's episode is This Where the Stock Market Crashes? Oh, we had a little bit of a down day today. Oh, no. You can see the 11 sectors were pretty much in the red other than healthcare. Utilities and energy were up there. Consumer staples was up there, right? Defensive sectors. And then towards the bottom, we had the big three: tech, financial, and consumer discretionary. In today's episode, we got a lot to discuss. We're going to be talking about expected moves for next week. We got a bunch of different indicators that we're going to be going over, and also some anchored VWAP levels too as well. We're going to be getting right into it. Take a look at the heat map today. You can see the big red squares like Amazon, that could put some weight on the market. Meta, Google, Microsoft, and Apple was only down, honestly, it was only down 1.51%. It really remained unchanged for the week. Okay, and we'll talk about what happened on the expected moves as far as the tech goes. But you can see healthcare was the one that was in the green today. This right here is the chart of the dollar. The dollar, we've been talking about this bull flag, and we're starting to break out, right? A lot of people have been saying the top of the dollar's in. It's not going to break here. Well, it sure looks like it's going to be headed that way, and it's been in an uptrend pretty much all year. So to just call this the top and then also call that the top, and well, they called that the top, it's anybody's game at this point, but to try to call tops and bottoms, it honestly is just a fool's game. You just got to be prepared and look at all the data. But you can see here on a pretty successful move to the upside this week, breaking out. It hasn't really impacted the S&P 500 all too much, and we know that there's a pretty strong inverse correlation between the two, especially if you follow me on Twitter. I said don't sleep on the dollar, and the dollar did make its move. But other big movers was bonds, right? So take a look at the 10-year yield. The 10-year yield was up 3.78% today. All right, that's important to watch, and we'll go over why here momentarily. If you take a look at TLT, this is the 20-plus year Treasury bond ETF. This was down big today, minus 1.61%. Now, this is, I've been saying this, for about a couple of weeks here, that the bonds have been kind of hard to gauge for the most part, right? They've been forming somewhat of a basing pattern and still can be at this particular point in time, but the 10-year yield kind of perpetuates to the upside. So we'll see what comes from it. I don't see a really strong play right here at this particular time. So I gotta let this see how this market digests, and we have some big stuff coming out next week, which we'll discuss. But okay, so the 10-year yield, it started moving up, right? On the week, up 4.91%. If you watched last weekly recap, or 2 weeks ago, we talked about this candle right there and how it was engulfing pretty much this prior candle, which could turn into a potential reversal. Well, we had 2 weeks of follow through to the upside. And what does that do for specific sectors? Well, XLK relative to the SPY is this line. XLY relative to the SPY is this line. And when you can see here, when this goes down, especially at rapid rate of change, you can see tech typically performs, and then consumer discretionary typically performs. But if you get bonds or yields to start pressing higher and higher at a rapid rate of change, well, guess what? They start getting hit, especially from a relative standpoint and even an absolute standpoint too. Now, what does good when TNX, starts rising like this, or the 10-year yield? Well, you can see here XLE relative to the SPY, energy relative to the SPY, moves almost hand in hand with the 10-year yield. So when the 10-year yield is rising, this correlation's been pretty strong. So you typically see energy start to perform. And, if you're not part of the Patreon group, which I'll talk about momentarily, there was something interesting that I noticed that I'll share with you guys that I posted on a couple of days ago, August 17th. But when I was running some scans, I noticed a couple of things. I noticed biotech, a lot of them were flagging, and then oil stocks, energy stocks, mainly oil, there was a lot of different type of basing patterns that were forming. And, I shared, the filter for that, to, how to pull that. I'm not going to go too much deeper into that one, but, this led me to post something like ConocoPhillips, and ConocoPhillips started moving. But one today was Oxy, which, everything was selling off today, but Oxy, we caught it right here within this little tight consolidation, and unexpectedly, how this thing moved up about 10% on the day. So energy stocks are catching a bid, which I find kind of interesting now, because we're talking about, the inflation top is in. Well, if oil rises, if these energy stocks continue to rip like this, well, inflation is going to be probably pretty sticky, and I think the market can continue to price in, hey, more rate hikes to come, which, seems to be the case, at least in this particular point in time. If we look at biotech, I said a lot of biotech names were flagging. Well, here's XBI. This is, a proxy. This is S&P Biotech ETF, a spider. You can also look at like IBB or something like that. But we saw this pretty nice consolidation here and then a big bump up in volume breaking out to the upside. And you can see right now, it's not really selling off on like incredible volume at this given time. So that leads me to believe if there is more sell side activity, you might want to look into this level over here, right? So a lot of those flags might actually potentially break down. But if we start getting IBB or the bigger ETFs into this area, it could offer up some good buying opportunities. Here's one, for example. This is FOLD. I played this one over here on this bull flag and it like just tricked me. Right, we popped out of it and then we started sinking off and I stopped out and now we're forming another one of these bull flags. But, if you're paying close attention, we do have negative divergences forming, bearish crossovers forming. So we'll see here if something like this, this is one of many that could potentially play off. Now, if you want to see more swing trade type ideas, you can come join the Patreon group. It's $9 a month. However, if you do it now, just know that Patreon, it's kind of weird how they charge. They charge on the first of every month. So if you buy now, it's $9 and then you have to do it again on the first. If you want to get around that and save money, just do it annually. It ends up being like $90 US, but you'll get access to swing trade ideas, the weekly watch list, which I'm going to be working on here after this, expected moves, and then you get access to the community, which is a group of traders and just people hanging out and sharing ideas back and forth. If we continue on, another big mover today was financials. Now you got to understand financials. This move really helped the S&P 500 a lot. And this break, well, this can really affect the S&P 500 a lot. This is one of the big sectors to keep an eye on, but that was a big move in XLF, down almost 2%, right? And on more volume than what we've been seeing. So it seems to be some sort of a distribution type day, which we can see here if it's going to have some follow through. You can see it tagged a lower weekly expected move. If you're in the Patreon, I've shared it a few times here, but in the Patreon, I could give these levels out on like 30 or 40 products. Okay, so this is going to be a big one to watch going into the following week. And if it starts sinking off, where can it potentially go to? Well, we have some area right around here, this little gap fill where we start to see it break out in some good volume. So if it comes down there, it could act as a potential level of support. Further down from that would be more towards this level over here. I've been personally trading XLF. I covered 50 basis points of my position today. I've been short. I think now I'm back to 1.5% net short on XLF. So it's a small position, and I've traded like 3 or 4 different times around it on smaller moves to the downside as this move's been progressively moving up. So I'm slightly down on the position, but not far from break even as I've been trading around it. Also to note that it is still overextended on the BP chart. You can see here, still in that overbought territory. So it makes sense that we're going to see some sort of a sell-off or consolidation, right? It's nothing new. We've been talking about this. Now, what I find interesting here is financials typically perform well, right? When the yield rises, right? The yield rises, boom, that's typically good for financials. Why? Well, financials, they borrow short-term, they lend long-term. However, what we've been stating was the yield curve has been inverted, right? So that is, it's still minus 27 basis points, and it's kind of curling up right here, which if you actually look through the history of the 10-year and 2-year and you put the S&P 500 up top, you typically can notice that when it starts getting back above from being deeply inverted, that's actually when the market starts to see a lot more pressure. So I'll show that on a different day. Let's go ahead and take a look at week-to-date performance on the 11 sectors. We had consumer staples leading the way, utilities, and then energy and healthcare. So once again, defensive sectors leading the way. Now, I will state that I'd say XLU and a little bit of XLP, just be mindful. This thing has been on a big, huge move in the last few weeks. And it could be getting a little bit overextended here. So if the VIX, remember, if the volatility starts rising up, anything and everything can get hit. It doesn't mean that it can't outperform the S&P 500 still, right? As from a relative standpoint, but utilities is getting a little bit, ahead of itself potentially, and it might need to see some digestion here soon. If we take a look at the big indices, week-to-date performance, the S&P 500 finished down 1.21%, so nothing crazy, right? It saw a nice big move to the upside around 43.25, and then rejected and closed basically around the low. Not the greatest looking candle. I would say that if we start getting below the low of this, I think it's very possible that we hit the 5-period weekly moving average, and we got to test to see if that acts as support or not. If we take a look at the Qs, a little bit more bearish here, minus 2.28% on the week. And you can see here, it was one big nice green candle at a start, and then it just reversed itself completely today, closing just around the low. So if we get some follow through, look for that 5-period weekly moving average to get tagged. And then also IWM down 2.85%. Look at meme stocks. They've been on a rapid run. I'm not going to even dive into them because I feel like, yeah, it's important to keep an eye every once in a while, but these things were just, it was so dead obvious that these things were going to fly and just completely collapse on themselves. And, for example, like Best Buy, Bed Bath and Beyond, whatever it's called. Okay, let's continue and move on. If we take a look at the SPY is getting somewhat rejected still from that 200-day moving average. We have a MACD that's curling over, okay? And this move to the downside, guess what? It didn't even hit the weekly expected move. So we didn't hit the upper edge. We didn't hit the lower edge. This everything that we saw so far in this, we'll call it little tiny consolidation, because that's all this really was. All we've seen so far was, really nothing. Really, honestly, nothing. So we got to continue to watch and see what develops, and we'll show what the new weekly expected moves are here at this given time. Now, keep in mind, too, and I'll show this a little bit later, but this day right there is going to be an important one to watch, and we'll talk about that in the anchored VWAP section. If we continue on, take a look at the Qs did tag the lower weekly expected move today. You can see if I zoom in here, you can see it tagged it twice here, looking at that 65-minute time period. Okay, so as it stands right now, we do have a bearish crossover taking place on the MACD. The drop came with some, elevated volume. So this is, considered to me a distribution type day, as we're running into overhead resistance. Now, we've already looked at a bunch of overbought indicators. So to see this consolidation makes sense, but we need to now, we're going to be honing in to closer time frames to really get a good idea as to where it might come to, because if you're bullish, you want to be at least prepared, or even if you're short, you want to be prepared where you can cover or to potentially buy the dip, okay? So we'll continue on here. Look at the IWM. This one did get below the weekly expected move, and a lot of volume stepped up. We had the MACD also curling back over, right? We're working off those overextended areas. Just be aware, this thing has been completely vertical. And remember, stocks, they typically take the stairs up and they take the elevator down. So do not rule out continuation of this move at this given time. We have a up-sloping 20-day, up-sloping 50. So now we really got to see how this move digests itself, okay? And that goes with each of the other indices. Now, if we take a look at a couple other things like the volatility index, this is the VIX. This was up slightly, but really not much, right? So if you're bullish, this is actually not too bad to see. However, it does leave room for a pop-up higher. We got that MACD crossing over. I don't know if that's going to lead to anything, but you can just see here, yeah, it was up slightly on the day, but nothing absurd, nothing too crazy here, given the context of today's moves. And then if you look at like the volatility of volatility, it was up slightly, but nothing crazy here either, right? You might, if you chart the VIX or the VVIX, you can say this is actually kind of basing here, and it's not going to be much longer. If we start getting above this, 92.5 level, we could see a spike significantly higher. And then we take a look at like skew. Skew actually dropped today. So I don't know. Is there something very, off about what's taking place overall in the markets? It doesn't seem nearly as bearish as what the price action entailed today, to be quite honest. Now, we do have a big week ahead. We have all kinds of stuff coming out. The big one that everyone's going to be watching is obviously Fed Jerome Powell. He's talking at the Jackson Hole, and that's on Friday of next week. So if we continue on, we can look at like the Fed Watch tool. We'll see here if anything new changes here, but as it stands right now, the market's on the edge, right? We don't know if we're going to do 50 basis points or if we're going to do 75 at this given time, right? There's a slight edge to this one over here at 50 basis points, but really it's anybody's guess, and that's going to have the markets a little bit uneasy given that we're walking into this Jackson Hole meeting here coming up next week. Let's take a look at indicators now. This is where, things are getting a little bit different, right? Are we going to see that crash? Is risk off actually going to start to really play out here? And one of the ones we've been talking about is the Bitcoin to gold indicator. If you follow me on Twitter, I posted the live update there because I couldn't get out of market brief yesterday, working on this new laptop. And you can see we did cross down through it. And well, guess what sold off? Bitcoin sold off. MicroStrategy sold off. Crypto equities, they got hit. Cryptos themselves, they got hit hard. So if you were prepared for this and you saw this and you watched this, you should not be caught off guard. Okay, and that's the biggest thing about risk managing, right? We dive deep into risk management on the last episode. So hopefully you're not caught off guard by this and, running around with, going crazy or trying to make big decisions in increased volatility. So yeah, Bitcoin was down pretty severely today. We'll get into that chart here momentarily. Now, this isn't actually technically an official sell signal based off of my strategy, but other people have different strategies. Some people will actually front run the signal when it starts turning down. That's totally fine. Some people will just play it as soon as it crosses a line. That's actually totally fine. You can do whatever you want. My signal, I technically have to wait for the week to close here, which it looks like it's going to. And then I need to have the new candle form, which is Sunday. Okay, so Sunday's new will be the new Bitcoin candle, and then it has to take the low of the prior week out. Okay, so for example, if all of a sudden this week we start getting bid up a little bit, all right, and then all of a sudden the next week, yeah, we get the sell signal here, but we don't actually take out the low of this prior week or this current week. Okay, if that doesn't happen, well, guess what? Then it's not actually an official sell signal on the strategy that I personally use. Now, if we take a look at Ethereum here was down, almost 11%, right? We talked about how expansion leads to contraction. Expansion leads to contraction. Contraction leads to expansion. We said it was going to happen soon. We didn't know if it was going to be to the upside or downside, but this is why we manage risk, okay? It was a big hit to the downside. And if we take a look at Bitcoin, right? A lot of people might think, well, that's too easy to see, right? It expanded, it contracted. Why would it fall again after it did it here and after it did it here? I don't know. It doesn't need to be overcomplicated. You don't need to overthink it. That's what happened, right? It expanded, it contracted, it tightened up, and then we saw an expansive move again, and it was to the downside. It would have been fine if it was to the upside. It would have been it's still an expand. You can see the markets always move between those two areas, contraction and expansion. Now, another thing that gave us a little bit of heads up is the the rate of change between growth and value. That told us just 2 days ago, right? It crossed down through the zero line and hasn't crossed down through the zero line since early June. All right, now when it crosses up through it, right here, we've saw some huge rallies. So keep in mind, like if you want this thing to turn back over and this gets back above zero, it could indicate that, hey, this is just a pullback and we just start ripping back up. Always a possibility, okay? But it's below zero right now as it stands, right? This is just one of many indicators. Now, if we take a look at relative strength in like the tech sector, where we take a look at like relative to the S&P 500, we can look at software, computer services, so forth down the list, semiconductors. I just wanted to call out that they are getting flat to heading down. Like, for example, semiconductors is below the 50-period EMA. Computer hardware is probably doing the best out of them from a relative standpoint. You have renewable energy is also doing pretty good, but kind of pointing down. But you're starting to see some of them turn over to flatten out a little bit here, okay? And those are more like tech-heavy, obviously growth industries. Now, if you take a look at the safety ratios, so we're looking at like gold, utilities, consumer staples, TLT, defensive sector, ETF, DEF, and then healthcare. These were heading down, right, for the most part, and now we're starting to see, right, these start to pick back up, okay, start to turn back up, and then also like utilities has been turning back up. So the safety ratios are starting to catch a little bit of a bid from a relative standpoint, okay? So that also signals to us what? Well, people are rotating. It's a rotation game. You can see tech, growth stocks rotating out of, safety rotating into. Is it going to continue? I don't know. We'll keep talking about the data that we see. Here's the a negative divergence that we talked about on the prior episode, so I'm not going to dig too much into it other than there you go. There's that higher high right there. So we have that higher high and we have that lower high right there. And we said what? Well, we've seen it plenty of times sell off when that happens. So these four are an example, but it goes back even further. And now we're seeing it again on a bigger scale there, looking at that purple line. Now, this also works as a buy signal too, right? A lot of people say, you've been so bearish, but they don't even realize that I was talking about also the buy signal down here on not only this, but there was also other indicators that were flashing buy signals where we had a lower low, and then the S&P 500 put in a higher low. And that right there, this one indicated this big rip in the S&P 500. Okay, and if you don't know what this is, you can watch the prior episode. I'm just looking at a ratio between S&P 500, right? S&P 500 relative to TLT, which is bonds, and then the S&P 500 down here below. If you just look at those divergences, it plays out sometimes. Another one to keep an eye on, which has been a popular little indicator, is looking at the rate of change between SPIP over GOVT. This is something that I randomly found just by randomly looking at random charts. But when the rate of change goes to around 1.3, it indicates potential volatility is right around the corner. Okay, so as I previously stated about volatility, I feel like something's off. Like it's kind of bullish right now. It's not doing much. Nobody's buying puts, it seems like, which is, once again, bullish. However, if you take a look at here at these red lines going down the screen, that marks all the times that the indicator actually flipped to, hey, warning, warning, right? And you can see, you got a pop in volatility, pop in volatility, pop in volatility, pop, pop, and then poppity, pop, 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 okay? And now what I'm calling out here is that we're starting to move up. Doesn't mean that it's going to tag it, but hey, if it gets back up to this 1.3, as it's pointing up there like it might, that could indicate that we might have some volatility just right around the corner, which could mean more potential downside in the markets. All right. Now, on the flip side of this one, I'll talk about it really quick. When it gets down to -2, it gives a green signal, and the green signal means volatility can be suppressed. You can see the last one was right here, and volatility is suppressed. Pretty cool indicator. Let's continue on. This is more bullish than anything right now at this particular time, but it can change. This is the summation index, okay? The summation index for the New York Stock Exchange. It's a broad market. You can see we're above 0. That's bullish, okay? And then we have the purple line. It's starting to curl over, but it's still above the parabolic SAR. Now, we talked about the bullish divergence here, right? We talked about that towards the market bottom. Now, I'm pointing out here that it's starting to curl over, and if the parabolic SAR all of a sudden clicks up to the top where the line starts curling down like this, it could indicate a change in trend. As you can just look back through the left of the chart, you can see that has been quite useful to determining trends. Let's continue on to a couple BP charts here. BPCO and PQ. Yeah, it's working off that overbought condition, We had that negative divergence. We started to see the mark go down a little bit. Now it's quick and fast down to 67.03, so it's no longer in that overbought condition currently. So that gave us a little bit of warning that, hey, we could see some digestion here soon. If you take a look at the summation index for the NASDAQ, also starting to curl back over. We're above 0, so that's positive. So we've got to watch for this parabolic SAR to start upticking and this to start curling over, which could indicate a change in momentum in the NASDAQ. If we take a look at the BPCO, I already talked about the BPCO and PQ. Let's go ahead and continue on to the BP. This is consumer discretionary. All right, we had that negative divergence. It's playing out, but it's not overbought or oversold. The technology sector BP chart, we saw the negative divergence. Now it's getting back below 50, so that is starting to play out to the downside. So we'll just continue to watch and see how this develops, if it gets back to oversold conditions or starts moving back to overbought. The Dow Jones Industrial Average is still in that overbought condition. Reminder that there's only, obviously it's the Dow 30, right? Dow Jones, it has 30 big mega cap stocks, so it looks a little choppy here, but it is technically in that overbought condition here via the RSI. Particularly the BPSPX also moved out of that overbought condition at 68.02 as that negative divergence is starting to play itself out. If we take a look at a couple bottom indicators, I want to look at the NASDAQ high-low, Cohen high-low, and you can see here, like when we get to this minus 0.05 reading, it typically marks out bottoms. Just look to the left of the chart, right? You can see here, coronavirus bottom, boom, right here, bottom, bottom. Even long-term capital management when it blew up, bam, to the upside, and even marked the dot-com bust bottom too. Now, the only time that it gets a little funky is in 2008. All right, in 2008, we hit the bottom, and you can just look down to the bottom of the chart here, and we had this massive bear market rally. Then it started turning back down, and we saw a big sell-off, and it started getting choppy right in here. But as soon as it started picking back up, it did, in theory, mark the bottom. Why am I pointing this out now? Well, we hit the bottom. We're starting to see a monster rally right now. Is this a bear market rally? Is this going to start turning back around and potentially head lower, which can take us potentially lower in the NASDAQ 100 and potentially see something similar to this, or if it's going to just kind of chop back and forth until this volatility, subsides even further. Time will tell. If we take a look at this one, this is the NASDAQ record high percent index. This one marks bottoms pretty well too. If you look to the left of the chart, you can see here this was the long-term capital management one where it came down to this 20 reading, and then when it crosses back above 35, it can mark the bottom. You have the dot-com bust right here. The financial crisis played it pretty well too. Over here, you can see it caught these bottoms. The reason why I'm pointing this out is because we did cross down through 20, and we do at times intra-week get above 35. It did not close there yet. And it does also looks very similar to 2008, right, where we see this, and we don't have much data to go off of, but it crossed down, it came back up to that 35 reading, but it did not actually successfully go over there, and we came right back down, started crashing, and then we eventually caught the bottom right over here. Okay, so we'll continue to monitor that and see what develops. Let's hop into the expected moves for the week. We're going to actually take a look at first the larger expected moves, and then we'll get into the weekly expected moves. So if we take a look at the S&P 500, you're going to see a couple lines on the screen. The thin line that's not dashed, okay, so just the thin line, that's what the options market depicted as risk for the month of August. Okay, so we tagged the upper edge of the month to date just about, and we started, backing off of a little bit. The dashed line is the quarterly expected move, so we'll see how that finishes, I guess, at the end of the quarter, right? So as it stands right now, we're above the monthly 5 EMA. We tagged the upper expected move already for the month, and we're getting some bullish follow through right now as it stands on the larger time frame in the S&P 500. Now, if you look at the daily time frame, the expected move is right around 430 to the upside, which brings us right back to this cluster, right by the 200-day moving average and this prior resistance. However, to the downside, take a look. It's right around 415, which brings us to this right here, prior resistance, and also prior support. So it's a very important level to obviously watch. Now, remember what I said. This day right here is a big one to watch because that's really obviously when the rally took off, right? So you can see right here, we sold off hard and intensive. It was resistance. We broke out support, and then all of a sudden volume picked up on that move. Okay, so we'll talk about that one a little bit later here. Let's continue on and look at the 65-minute time frame. Something that is going on right now is we had a now weekly close below the 5-period moving average, and the 5-period moving average, it's going to somewhat neutral here. So the market has to recover quickly in order for this to start turning back up. The longer we stay below it, remember what we talked about, it's going to start curling back over, right? It's going to go neutral more and then start curling back over. We might test it a couple of times, and then we could short back through it if you are looking to short, okay? But you don't really want to chase these strong moves because as we've seen prior, right, just looking back, we've just went low to a low to a low to a low, and they've gotten bid right back up, right? Bid right back up, potentially get bid right back up here too as well. So we'll continue to monitor that. At the lower end, I will say that there's this volume shelf right over here, can potentially act as a magnet. That lines up right with that lower expected move and the trend line of this, broadening wedge pattern that's forming. Let's take a look at the Qs. Qs tag the upper monthly expected move. Now we're sitting right around the quarterly expected move in bear market territory. We came out of it, everyone celebrated, and now we're back in it on the weekly close. But we are right there on the weekly 5 EMA, right? Wind is still at our face if you look at the indicators, like the PMO. So this, potentially can start curling back around. We just need more time, unfortunately. If we take a look at the daily time frame, big increase in volume on today's move, and it was clearly a distribution type day as we moved into an area of resistance. Go figure, right? A strong move, right? If people chase into an area of resistance, not the smartest thing to do, has to digest. Okay, that's just what happens in markets. Okay, you get expansive moves, then you get contraction, then we potentially expand. You get expansion move, contraction, then potentially expanded moves again. But that can happen in both directions, right? We don't know yet. That's why we look at weekly expected moves to depict what risk can potentially be following next week. So 315 on the low end, just above 330 on the high end. Let's continue on at the 65-minute time frame. You can see here, negative divergence is playing out to the bottom, to the downside. We are below the 5-period moving average, and it is still overall inclining. So the longer we stay there, could neutralize to start declining. So we'll continue to monitor that, see what develops. If we take a look at IWM got above the monthly expected move, floating around the quarterly upper expected move, and it's also floating right around that bear market territory, the red shaded line. And we're above that, obviously, monthly 5 EMA there too as well. If we continue on, the IWM on the daily time frame, what's the expected move? 200 to the upside, 190 to the downside, give or take a little bit right there. I don't have the exact numbers in front of me, although these are, the levels are exact because I typed them in manually. We can see here the 200-day moving average is still holding as a level of resistance, and we do have a big volume day on distribution, right? And we have this turning itself over to the MACD. So we'll see if we get some follow through there too as well. If you take a look at the 65-minute time frame, back below that 5-day moving average, not looking all too healthy right at this particular time, but neither did it, right here, right? And then we started firing back off. The 5-day moving average on the IWM has been holding as a level of support. So we're now officially starting to get breaks below it. The longer we do that, like we said, start to look like that for potential short opportunities if it's going to hold down into those levels. Now, let's get even more granular and look at some anchored VWAP levels. I'm going to show you the 65-minute time frame and break this down for you. So the gray shaded area that's wavy in the back, that's the 5-day moving average. Okay, so basically all it says is we're trading under the 5-day moving average. Now, the yellow line, that is the month-to-date anchored VWAP. Okay, that's for the SPY. And then right here is that pivotal day that I was talking about, how that's when the rally actually really started. Okay, so I anchored it to the gap up when the market really started ripping on all that volume. Now, the reason what I find this so important is because look at how it basically held. It held. It's holding. So since this gap up, the average buyer based off of this, is in the green, right? To put it easy. So if we start breaking down the month-to-date VWAP and potentially this one, that could potentially bring more bearish psychology to the markets, right? People might get a little bit more bearish, and that is where we can potentially see stronger moves to the downside to potentially even fill this gap. Okay, so this level, 415, is going to be a big one to watch, a big one to watch. And then we also have that 420 level there too. Okay, so that's for the SPY. Doesn't look the same for the Qs, right? The Qs is actually trading below the 5-day moving average and below the month-to-date anchored VWAP. Okay, and now you can see it's pinned between the anchored VWAP on that big burst day, which really kicked off this rally, and it held its support here, it held its support here. So now we're pinned between these two. So if we don't recoup this level and the 5-day moving average continues to curl itself over, if we start breaking this level, watch out, because that opens the door for significant amount more downside, potentially to even fill that gap, okay? And now if you're paying very close attention, you know that if this gap is filled, gaps can act as a level of support, they're a level of interest, and this gap up happened on big volume. So this down here, be ready to cover if you're short or to potentially play long, but we'll have to know, we'll have to analyze price when we actually get to that level, if we get to that level. If we take a look at the IWM, it is just hanging on to the month-to-date anchored VWAP. It's below that 5-day moving average, right? And you can see here on the day that everything took off, boom, it acted support, and then we haven't really touched it since, but we are, not too far off from it. So if that 192 level starts breaking, be aware that we can come backfill, okay? That's a very important VWAP to keep an eye on. We talked about a lot in today's video, right? The main question of the video was, is this where the stock market crashes? And to be quite honest, this is how crashes can develop, but no one's actually going to know whether or not the market's going to just crash. This is a business about risk management, and that should be nothing new to you, only to the haters. See ya.